No. Think about this.
Management remuneration?
Interest.
No. Think about it like this. Again from the
Opportunity cost?
no. Again from the grassroots level. Why? What? Why? How much? 3 questions. Left on its own, can a brand name earn this operating income? Only with the brand name. No buildings, no human resources, no working capital. We are valuing brand name.
Tangible.
Operating profit that we have taken is from the company annual report. We have to remunerate the capital for its usage in the process. And I think they've used something like 20% or something, less than that, 16-17%. So they take the capital employed and assume a particular percentage on the capital employed. That's a capital charge. You heard of the concept economic value added? I think Stern Stewart or something. Yeah, Stern Consulting. So how is EVA defined?
Capital employed minus net operating.
Sorry?
Net operating minus capital.
No, you have a return on capital employed. From that you are deducting the capital charge. So capital charge. So same way we are talking about excess returns. One way of coming at that excess returns is to remunerate the capital in whatever form and then see the brand related profits after tax. Okay, the effective tax is then reduced. And the next important one is 10.64 brand earning multiple. Once we get a hang of brand earning multiple, we know how Infosys has come to its brand valuation. Pretty straightforward, right? This is one way of doing things. Now, how did they come to brand multiple should be the question, right? Now, brand multiple is a function of how big the company is, the talent pool of the company, in how many geographies it is present, the degree of their success rate in their product launches like Finacle and all, banking services, and the name Infosys itself, right? And when you compare this in that particular industry, you arrive at a composite number, any sort of, it's a relative value sort of multiple, right? So it's a multiple that you can assign to the earnings, brand related earnings, to come to the brand name value. In other words, I mean, it's subjective. Infosys could have done 15, they could have done 5, it's their measure. Again, if you choose a number and on so many parameters you find a multiple and support it with some market related research database or something. But majorly we have understood one way of doing it, which is brand earnings multiple method, right? Yeah, I think KPMG. Now this is a very interesting method, royalty relief method. I'll not get to the full valuation, but I want to touch upon a very important concept here. Somebody asked the question, how do you come to brand related cash flows out of the total cash flows, right? Again, think about it from the grassroots. If I don't own that brand name in the form of the trademark, what would happen? If I have to be present in that industry, if I have to sell those products or provide that service, how can I do it? If I have not generated such a big brand name, what would I do? I would become a franchisee of an established brand name owning company. If I am not the owner of Burger King, assume I am the owner of Burger King, I have my own brand. But if I tried but I could not establish as a Burger King, what I would do if I still have to be present in that line of activity, better for me is to take up a franchisee of McDonald's. All of us are on the same page? Yeah. And if I take that franchise, I'll have similar sort of revenues when you compare with Burger King or McDonald's in a particular store, in a particular establishment. But in the hindsight, I will have then to pay a royalty on those cash flows, on those revenue. By virtue of my owning my own brand, I'm not paying royalty. So to value brand, I can use relief from royalty as the cash flows. So it's not that incremental cash flows can only come from the revenue. The costs that I save is also leading to value proposition, right? And once we know that is the cash flow, you can use brand earnings multiple. Sorry, we'll not use brand earnings multiple because it's doing a capital charge. When we use a royalty relief method, it is already assuming that all the capital and everything is done by the franchisor. We straight away use that cash flows, make it after tax and discount it. Straightforward, royalty relief method. One of the very popular methods for valuing brand name. So I've given you the crux of royalty relief method. The templates will all be same. Once you have the first line cash flows, you use your after tax, you make it after tax, adjust it, use your discounting method, you'll get a value for the brand, right? Again, this is one method from the cost approach angle which I thought could be useful. It is there in Damodaran, but I have made it, I have taken it one step further from there. What Damodaran has done is, he's gone 25 years back in the history, and he said whatever advertisement spend has been incurred by that particular company contributed to the brand name. Not 100%. So what he has done is, this is the ad spend. When you say -1, when we are saying 0, it's now. When you say 1 year back, -1, -2. So you go 20 years back in the history. Is used. Now these are arbitrary numbers, not what is there in Damodaran. I've just assumed some numbers, hypothetical. Your ad spend for the last 20 years. I have adjusted it for inflation to say 10 rupees spent 20 years back would be worth 10 into 4.66 now. I've used 8% long-term inflation in India. I mean, it's a high thing, but you can use your own thing. Inflation adjusted for inflation. Inflation adjusted, not cash flows, advertisement spend, not admin, advertisement spend. And then you sort of do a presumptuous percentage, say 50% of total amount spent on advertising contributed to my brand name, which brings us here, right? Now all these spends contributed over the last 20 years, he says 25 years, I've just used arbitrarily 20 years. We have inflation adjusted brand related advertising spend for the last 20 years. What is the amortization this year? All 20 years are exhausted. So what is the unamortized balance left now? 0. What is the unamortized portion left from this year? 1 year worth of amortization is left, taken here. How much is left from here? 2 years worth of amortization is left as of now. 18 years amortization over, totally 20 years. 2 years worth of amortization is left, so this into 2, 3.2. Like this, it gives me a value of 537 crores or whatever number. Amortization is 1 by 20. By 20, amortization. The lifespan is 20 years. I see that every rupee spent now will have a life of 20 years supporting the brand. But Damodaran has not done this thing, right? So I think this will be more relevant. Otherwise that 537 would have been somewhere 350 or something, right? So that more sort of brings it to current value terms. Yeah, you're saying out of the total expense, advertisement expense, everything will not contribute to only brand name. You just do it as a normal routine. Like somebody said why he has joined this program is there was a budget he has joined. Sorry, I'm just lighter. So I'm trying to say that everything will not be only for promoting the brand. So you take any call. You can take 60%, 75%, 40%, whatever call, right? But this way of doing it gives you another perspective from the cost approach to arrive at a brand name. which again you will not find in any book. This is picked up from Damodaran, yeah, with the numbers, if I'm right. Numbers are also same, and I think yeah, this is the last bit on brand value. Are we clear about the concept of market capitalization and enterprise value? What is market capitalization? What is enterprise value?
Market value.
What is market capitalization? Total number of shares traded. Total number of shares traded into
Market value per share.
total number of shares issued. Outstanding. Outstanding.
Available in market for trading.
Available for trading.
Total number of shares. Total number of shares into
Issued number of paid up capital.
Yeah, issued or outstanding, subscribed, whatever. Yeah. Total number of shares outstanding. Let's make it simple. Total number of shares outstanding into the CMP, current market price. That's the market capitalization. Simple. Anybody can take an Economic Times, compute. I mean, in fact, market capitalization itself is there nowadays, right? No need to compute. But then, what is firm value? There is a company in Chennai, right? It's MRF. The share price is 10,000 rupees, I think. 10,000 rupees per share.
Capital is 100 crores.
The last time I saw the share capital, it was 4 crores.
Correct. Reserves are
So the reserves are the main thing. But here again, this is off the track, I'm just mentioning. This is known for one of the least capitalized sort of company, MRF, so I'm just sharing. But broadly, we want to understand the difference between, now we saw what is market capitalization. If we add the outstanding debt to that market capitalization, in fact, if we add the net debt, that is what we are doing, we arrive at the enterprise value. Net debt is net outstanding debt, net of cash, minus cash balance. Because if we want to value the business, we are not going to pay for the cash balance available on the asset side and then settle some of the liabilities. You might as well consider net debt, right? Otherwise you say, you take your cash, I am just interested in your business. Why would I, pay for cash and have cash in my bank balance? I'll bring my own cash, how much ever I want to keep. So you do net debt adjustment. Market capitalization plus net debt adjustment gives us enterprise value. And in most of the companies today, enterprise value has more significance, not market capitalization. That's because they are highly leveraged. And if you see the capital turnover ratios, the kind of revenues and cash flows they are generating, it was never going to be possible without the debt. So what is important to understand the whole sort of value chain of that particular enterprise is the enterprise value or the firm value, not only the market capitalization. We are talking about times where we have debt equity ratios of 4.5 and a 5. So enterprise value will be more relevant. Yeah, somebody was... Whatever is the total external outstanding debt as on the valuation date.
including short-term, non-current.
No, short term will be going into the working capital sort of thing. If you have like credit lines and all, that will not be included in there. It's generally long term, but long term, medium term, you can take all that. If it's in the form of bank overdraft or credit lines or cash credits, and all that can be used in working capital. So this much is clear. There's a branded company B and there is a generic company G. We have collated the information from their published accounts, and this also, the sales, EBITDA, capital invested, and the EV multiples of both these companies. Enterprise value we have sales, EBITDA, capital invested, so we can arrive at all these things. Now what I've done here to value the brand name of company B is I've taken this sales of the branded company times EV by sales of branded company minus EV by sales of generic company. You get my point? So which is 21,962 into bracket 4.49 minus 0.77. This gives us this value on the basis of sales, on the basis of EBITDA, on the basis of capital invested. You can use any one of them, range, average, weighted average, but this is from the market value perspective. Why market value perspective? Because we are talking about multiples. What EV by sales, EV EBITDA multiples are there in the market as a whole in that industry. We are using that. So what did we see? We saw brand earning multiple method. We saw inflation adjusted cost approach. We saw relief from royalty method, royalty relief method. We are seeing the market approach. So many different ways of valuing one brand. Of course, different companies, different numbers, hypothetical scenarios, just to give a flow of how we can also do it. Templates are there. This is there in Damodaran, so no need to.
You can come out with our.
No, see, these are some guidelines, and these are, celebrity books.